Welcome back. Let's be honest, we're living in an era of what feels like permanent volatility. A single news headline, a surprise economic report, and boom, the market goes haywire. So the big question on every long-term investor's mind is, how do you navigate these choppy waters? How do you protect the gains you've worked so hard for without just cashing out and hiding on the sidelines? Well, today, we're going to break down exactly how the pros use a specific set of tools, derivatives, not to gamble, but to build a fortress around their portfolios.
You've felt it, right? That knot in your stomach when a stock you love has just had a monster run-up, and that little voice in your head just gets louder and louder, screaming, "Sell! Lock it in before it all disappears." You know, that fear of loss is one of the most powerful and, frankly, destructive forces in investing. It's why so many of us sell our best performers way too early, and it's the exact problem we're here to solve today.
And that's the million-dollar question, isn't it? If you just hold on for dear life, you risk watching months of hard-earned profit vanish in a couple of bad days. But if you sell, you're on the sidelines, probably missing out on the next leg up. It feels like a lose-lose situation. But there is a third option. What if you could stay in the game, keep your shares, but build a rock-solid safety net right underneath them?
So this gets us to a really crucial mindset shift. Volatility is not the enemy. It's just the price of admission for getting those great long-term returns. The real danger, the thing that can knock you out of the game for good, is a large, permanent loss of capital. That's what happens when fear completely takes over and you panic sell at the absolute bottom, locking in those losses forever.
And this slide, man, it just perfectly captures what one of our sources calls the brutal truth of retail investing. We completely ignore risk when the sun is shining and the market's going up. But the second the house is on fire, we're scrambling to find insurance. This is the exact opposite of how the pros approach risk, which leads us to a really, really important concept.
Let's talk about the VIX. You've probably heard it called the market's fear index. And the analogy here is perfect. Just think of the VIX as the cost of an insurance premium on your stocks. When everything's calm and the VIX is low, that insurance is dirt cheap. But when panic hits the market and the VIX spikes, that exact same insurance policy suddenly becomes outrageously expensive. And that's the trap. Most people only think to buy insurance when the house is already engulfed in flames. Professionals, on the other hand, they buy it when it's on sale.
And this right here, this lays out the two mindsets perfectly. The amateur reacts to fear. They see a sea of red, they panic sell their best assets, and then they end up overpaying for protection after the damage is already done. The professional prepares. For them, hedging isn't some emergency button they press. No, it's a systematic, core part of their entire strategy. They use these tools to define their risk upfront so they can stay cool, hold their positions through the storms, and be fully invested to capture the rebound.
Okay, so how do they actually do it? Let's get into the first tool in the pros toolbox. It's the most straightforward way to protect your stocks, and it's called the protective put.
A protective put is, well, it's exactly what it sounds like. You are literally putting a layer of protection on your stock. It's a type of derivative called an option, and it really is the closest thing you can get to buying a real insurance policy on a specific stock. It's your way of saying, hey, I'm super bullish on this company long-term, but I also want to be able to sleep at night knowing I'm protected from a nasty drop in the next few months.
Okay, so let's break down how this actually works. It's surprisingly simple. First, as you see here, you need to own at least 100 shares of the stock you want to protect. That's because one standard options contract always controls 100 shares. Then you just buy one put option. Now, a put option is just a contract that gives you the right, but not the obligation. That part is key, to sell your shares at a specific price, which is called the strike price. So no matter how far that stock might fall, you have a guaranteed exit price locked in.
And the outcome of doing this is incredibly powerful. You've essentially built a hard floor underneath your investment. Let's say your stock is trading at $100 and you buy a put with a $90 strike price. You now know with absolute certainty that the worst you can do is sell your shares for $90 each, even if the stock craters to 50. Your risk is no longer some scary unknown thing, it's a defined, manageable number.
Okay, but there's a catch. Just like any insurance policy, buying a put costs money. You have to pay what's called a premium. But what if you could get that insurance for free? This is where we get into a more advanced and, frankly, beautiful strategy that the pros use all the time.
It's called a collar, and you can think of it like you're putting a bracket around your stock's potential price.
You still own your shares, and you still buy that protective put to create the floor just like before. But now you add one more step. You sell a call option. And a call option gives someone else the right to buy your shares from you at a higher price. This creates the ceiling.
And this quote from one of our sources, it just perfectly nails the genius of this strategy. See, when you sell that call option, another investor pays you money, a premium. You then take that cash you just collected and you use it to buy your insurance, that protective put. It is a brilliant and elegant piece of financial engineering. So let's walk through it one more time. Step 1 is the same. Own your 100 shares, buy your protective put. Step 2 is the magic move. You sell one call option. By doing this, you're collecting a cash premium from another investor. And in what's called a zero-cost collar, you can pick your prices so that the money you get from selling the call perfectly pays for the put you just bought. You've essentially created insurance out of thin air.
So what's the catch? Because there's always a catch, right? Well, the trade-off is right here. You've put your stock in a box. The amazing news is you have downside protection, that floor, for potentially zero out-of-pocket cost. But there is no free lunch in the markets. By selling that call, you've also capped your upside. If the stock absolutely goes to the moon, you've already agreed to sell it at that ceiling price. You've traded away unlimited upside for a defined and limited risk.
And that trade-off, that really gets to the very heart of the professional mindset. See, hedging isn't about trying to get rid of all risk. It's about being intentional. It's about looking at your portfolio and consciously deciding, okay, this is the risk I am willing to take, and this over here, this is the risk I want to insure against.
Now we have to be honest about the downsides, because this isn't a magic bullet. As our sources point out, these hedges can get expensive if you aren't careful about how you structure them. Your protection is also temporary. Remember, options have expiration dates. And collars, by their very nature, are going to limit your potential gains. And most importantly, this is not a set-it-and-forget-it strategy. It absolutely requires you to actively manage these positions.
Which brings us to the final and I think the most important question of all. This is the core takeaway of this entire explainer. The tools are out there. These are the exact strategies that the most sophisticated investors on the planet use every single day. But using them requires a fundamental shift in your mindset, from just reacting to volatility to proactively managing it. So the choice is yours. Are you going to keep selling your winners and hiding in cash every time things get scary, or are you ready to learn the tools to stay in the game and manage risk like a pro?